the Fed has decided that it's going to end quantitative tightening, the shrinkage of the balance sheet of the Federal Reserve in December, and this continued pressure from the White House to loosen up, lower the Fed funds rate. That's a little bit of a yellow light flashing in my eyes when I look at what's going on, because what will happen, I think, maybe, is that we'll get an acceleration in the growth rate in the money supply. And of course, we'll have inflation won't be contained.
Professor Steve Hanke, professor of applied economics at Johns Hopkins University and the founder and co-director of the Institute for Applied Economics, Global Health, and the Study of Business Enterprise, and the author of the new book, Making Money Work, How to Rewrite the Rules of Our Financial System. It is so wonderful to welcome you back to the show. Great to see you as always, Professor Hanke. I really appreciate you taking the time today.
Great to be with you, Julia.
It's always a pleasure being with you, Professor Hanke, and this audience loves you. And it's been a while. It's been 5 months since we had you. So we're definitely due for a check-in, especially as we finish the year here in 2025. And Professor Hanke, since it has been a while, let's start where we always start, big picture, more of that macro view, where we are in the economy, and let's throw markets in there. What are you paying attention to these days? What's not getting enough attention? And what's sort of your outlook going forward? And as you know, Professor Hanke, you can take all the time you need to set the table.
Okay, the big picture, let's just start in the United States, since that is the capital market of the world. So, and depending on how you measure it, actually, it's the biggest economy in the world too. And right now, it's probably the biggest disruptor from an international policy point of view in the world. So we have the main thing to focus on is the money supply. What's going on with the money supply? Because that's the fuel for the economy. And the money supplies started to grow after going up a lot after COVID, giving us inflation, and then contracting and slowing the inflation way down. And now then this money supply started going up. So it's still a little bit on the anemic side. It's growing at about 4.5% per year. My golden growth rate, a rate consistent with hitting a 2% inflation target, is 6%. So, but it's accelerating, and the thing to watch is where the acceleration is going to go. Are we going to be on another roller coaster ride? And we might be. That's really what concerns me, because there's a lot of pressure on the Federal Reserve to loosen up and open the money supply spigots, shall we say. And when you look at that, we already have the following things that are tipping us off about where we might be going. And one of those is that the Fed has decided that it's going to end quantitative tightening, the shrinkage of the balance sheet of the Federal Reserve in December, next month, a few short days, actually. So that will loosen things up. The other big thing, and something that Matt Sakurki and I talk a lot about in the book that you held up, Making Money Work, is that bank regulations, they don't change that often, but they have an enormous impact on the growth rate in the money supply and the capacity of commercial banks to actually extend credit. And once they extend credit, of course, that increases the rate of growth in the money supply. So what has happened is that there's something called the special liquidity ratio, supplemental liquidity ratio. And that was imposed on banks after the great financial crisis in 2008. And they're going to remove that. Now, by removing that and deregulating, shall we say, that will have an enormous impact on the capacity of commercial banks to make loans. It'll give them a lot more potential firepower. the estimates are around $2.6 trillion in capacity. So that's a big change that no one pays much attention to, but it's big. And that, along with quantitative tightening and this continued pressure from the White House to loosen up, lower the Fed funds rate, that's a little bit of a yellow light flashing in my eyes when I look at what's going on, because what will happen, I think, maybe, is that we'll get an acceleration in the growth rate in the money supply. And of course, we'll have inflation won't be contained. Mm. By the way, the bubble in the stock market will continue to expand, because if you have acceleration in the money supply, just like we had the last time in 2020 and 2021, Julia, what happened? The first thing that happens with a lag is that asset prices go up, real estate goes up, land prices go up, the stock market goes up, all assets inflate. Mm-hmm. So that's my concern. So right now everything seems to be running relatively smoothly in the U.S. The labor market's getting a little weaker. And by the way, that also is another tip off as to what the Fed will do, because the Fed historically has always kept its eye more on the labor market than anything else. And now, by the way, they don't keep their eye on the money supply at all. They poo-pooed the quantity theory of money and the whole idea that there's a connection between changes in the money supply and changes in asset prices, changes in economic activity, changes in inflation. The Chairman Powell is rejected all of that, even in testimony. Mm-hmm.
That's because, as we've talked about, they have all the neo-Keynesians are over at the Fed. We need more monetarists.
You've got the neo-Keynesians in charge, and the focus is on things that the neo-Keynesian focus on. And if you look at their macroeconomic models, they don't include a variable for the money supply, by the way, mm-hmm. but they do include interest rates. So we have this obsession with what's going to happen with the Fed funds rate, what's going to happen with the Fed funds. And it looks like, by the way, the probability of a 25 basis point Fed funds reduction at the December 10th Federal Open Market Committee meeting, that's been fluctuating all over the place.
Oh, crazy.
A month ago, the probability was about 99% that there would be a 25 basis point cut. And then about a week ago, it was about it had dropped to about 40%. And now, I haven't looked at it today, but it's up around 70%.
I think that's right. Or I think I even saw a headline from Reuters overnight. It was like 80%, but it's like all the Fed speak that, it is fluctuating.
So this is, and it fluctuates depending on what the members of the Federal Open Market Committee, if they give a speech someplace or they're on a podcast with you, Julia.
Oh, we haven't had any Fed governors on the pod, but
if they say something, well, it jumps around. Mm-hmm. So the last one, Waller, who's one of the Fed governors, who's tended to be a little bit on the hawkish side, indicated that he thought maybe a 25 basis point cut was in the cards, and boom, all of a sudden, the probability of that rate cut, interest rate cut by 25 basis points, zoomed up from 40 to you say it's 80 now.
I think it is. I don't quote me on it, but I'm pretty sure that's the headline I saw. But
so at any rate, this is part of the overall message that I want to get into the picture, and that is, if you focus on the quantity theory of money, it's steady as you go. You keep the money supply growing at about 6% per year, and you will end up with about a 2% inflation.
Mm.
But we don't pay any attention to the quantity theory of money. We have all these ad hoc theories, post Keynesian models, and so forth, and we have up and down, and it comes in even in the micro kind of thing, where day to day the probability of what they're going to do with the Fed funds it shifts around every 24 hours, and that is because the Fed is what they call data dependent. They watch the daily data, and the guy in the street, it's a finger in the wind kind of approach. If the wind's blowing one way one day, that's the policy orientation. If it shifts and blows the other way the next day, the policy orientation shifts and blows the other way. So as a result of this data dependency, you have basically a lot of instability.
Mm-hmm.
And by not looking at the quantity theory of money, you get this flying blind kind of approach too. If you're not looking at the money supply and paying any attention to it because you don't think it affects asset prices, real economic activity, or inflation, well, you're flying blind as far as
we should send them a copy of your book too.
Well, I've done that.
Yeah. Okay. Well, they need to read it. Professor Hankey, I want to explore something with you because you got my attention when you were talking about this kind of roller coaster, yellow light flashing, the resurgence in inflation, because you and John Greenwood accurately predicted that surge we saw in inflation, really exactly the 9% we saw. And so when I hear you talk about inflation, I want to pay attention and listen. And it sounds to me like there's this real risk that we could see the resurgence, that increase in the money supply, which pushes the asset prices higher, like land, real estate, stocks. It makes me wonder, well, one, I want to hear more on the thought on where we could head, but it also just makes me wonder, we're going to only exacerbate more inequality. And the Fed says they like serve the public interest of like the American people. It seems like that I mean, that's who it hurts the most. Is inflation hurts the most. It doesn't really hurt the asset holders. It's the everyday Americans. But I'd just love to hear more of your thoughts on inflation and the concerns there.
That's a great point that you bring up, Julia. In the book that Matt Sakurki and I co-authored, Making Money Work, we have a long elaboration about the importance of the monetary policy being neutral, and no one really pays much attention to this. It turns out, interestingly enough, in the last issue of the International Economy, Secretary of Treasury Besant went on about this point that you're raising about quantitative easing. What did it do? Well, it made income inequality. It exaggerated the inequality. It led to more inequality. He didn't label this as we do in the book from a technical point of view. It is neutrality, and what we've had is non-neutral monetary policy. In other words, you should have a monetary policy that isn't distorting things and favoring one sector of the economy or one group of industries or one group of people. And the best way to get a handle on this, to show you what the Fed has done with income inequality, is to look at the percent of GDP accounted for by the wealth of the billionaires in the United States in January of 2020. And that percentage was 14.1%. Billionaires' wealth as a percent of GDP was 14.1%. Now, after we had this goosing of the money supply, the asset price inflation, general inflation measured by the consumer price index, now it's 22.7%. So the income inequality has been almost manufactured by the Fed, and this turns out to be a real problem because we have an economy now. And another thing I'm very concerned about is that what they call a K-shaped recovery. You have the top line on the K, the rich have gotten very rich, as I just indicated. And what are they doing? They're doing what they always do. They spend a lot of money. They have a lot of money and they spend a lot of money. So 2/3 of gross national product is made up of consumption.
Mm-hmm.
And 50% of that consumption is accounted for by the top 10% of earners in the United States. So the consumption is a big part of GDP, and it's basically driven half of it by the top 10% of income earners in the United States. And what happens at the bottom part, as you indicated before, the bottom part of the K is in a slump, because what happened with inflation is that wages didn't keep up with inflation.
Mm-hmm.
So adjusted for inflation, wages, real wages as we call them, actually went down and slumped for the people at the lower end. So you have this K-shaped recovery. It's not a neutral recovery. It's not a straight line going across. You got the top of the K going way up and the bottom part of the K slumping and going down. And that's why this political issue, and another thing to keep your eye on, is this affordability thing.
Yep.
We have a new mayor that will be
Mamdani, yeah, New York City.
Big time, and Trump, you see, has picked up on this. Why do you think all of a sudden, from calling Mamdani a communist, he was in a love fest with the guy last week, because Trump he has his finger in the wind too, and he knows that this affordability thing is a big deal.
Do you think it's reaching like a crisis point, affordability?
Well, I wouldn't. I don't like to use words like crisis and the sky is falling and that kind of thing, but it is a real political problem, and it's because of the downside on the K. And where does that come from? Well, again, a lot of it comes back to the Fed. Now, also, the Congress is on the hook for this, because why did the Fed goose the money supply? They goosed the money supply because when COVID hit, the government shut down, economy shuts down, taxes go way down, government spending goes way up, the deficit gets huge. And how did they finance that deficit? They sold treasuries to the Fed. And that meant what? The money supply was increased, because over 90% of the deficit was what we call monetized by the Fed. The treasuries were sold to the Fed. When the Fed extended credit to buy those, that increases the money supply. And that's why the money supply shot up so fast. So ultimately, the Congress is in bed with this thing too, and making money work. The book goes into this. You have to pay attention to what's going on, not just at the Fed, but what's going on the fiscal side of things, because it can, if the Fed allows it, it can slop over and affect the rate of growth in the money supply, depending on what the Fed does.
This episode is brought to you by VanEck Rare Earth and Strategic Metals ETF, ticker symbol REMX. Rare earths are the hidden backbone of modern technology and defense, powering everything from smartphones and electric vehicles to fighter jets and wind turbines. VanEck recognized this early, launching the Rare Earth and Strategic Metals ETF, ticker symbol REMX, 15 years ago, well before supply chain security became a global priority. Today, China dominates the production and refining capacity of rare earths, creating real challenges for global supply chain security as these materials are essential for technological innovation, clean energy, and national security. That's why countries all around the world are racing to build their own supply chains and reduce reliance on China. As this global shift continues, investment in the rare earth ecosystem is growing rapidly, from mining to advanced manufacturing. Investors can gain access to this powerful trend through REMX. Visit vaneck.com/REMX Julia to learn more. Professor Henke, you had mentioned earlier too, this market, this asset price bubble, that it can grow even more. I know you as someone who also has your bubble detector. Where do you see things right now as relates to the market, asset prices, these valuations? Where do you see things headed? What kind of concerns you right now?
Well, right now we are at the bubble detector. Dr. X's bubble detector, mine is at an all-time high right now. So the question is, well, is it going to go higher? And I'm not predicting now. I'm saying there is a plausible scenario, as I say, with this. If the Fed allows this loosening to occur, then we could have a bigger bubble.
Mm-hmm. Okay. What based on the quantity theory of money, what do you think the Fed should do? Should they just hold tight? I mean, I get we're just talking about Fed funds rate and monetary policy. One of the things I learned in your book, it is so much bigger than the Fed funds rate. But what do you think the Fed should be doing from a monetary policy standpoint right now that would make the most sense based on where we are in the economy?
Well, I think they actually have done two things that I've proposed for a long time, and they finally have done them. I think they should have done them a year and a half, maybe 2 years ago, and that is the stop quantitative tightening. Okay, that's one thing, and this bank deregulation, the supplemental liquidity ratio. I've been opposed to that, as of course all the bankers are opposed to it too. So two things have happened.
The bankers like the deregulation part, right?
Well, they like the deregulation part because they don't have to hold as much capital relative to the credit that they are extending. I mean, it gives them more capacity. It gives them more firepower, basically.
Okay.
And so, yes, they like it. And I think the supplemental liquidity ratio was a binding constraint and unnecessary. I think it was unnecessary and should have never been put in the first place. One reason, by the way, that we came out of the great financial crisis so slowly is because of the Dodd-Frank Act, which this supplemental liquidity thing came in. The noose that Congress put around the banks, squeezing the banks. Remember, the banks supposedly caused the great financial crisis. So we had Dodd-Frank and more constraints put on the banks, more bank regulation. And that actually put us in a situation where for a short period of time, the banks were actually not contributing to the growth in the money supply. They were reducing their contribution. And that was very important because commercial banks produce about 80% of broad money in the United States, measured by M2. The elephant in the room in terms of producing money is it's commercial banks. So that's one reason that Sakurki and I spend so much time on bank regulation in our book, Making Money Work, because the banks are, in fact, the elephant in the room. So if you change the way they're regulated, it will change the capacity that they have to make loans. They might not necessarily make them. That depends on business conditions and business confidence and so forth. Even if banks have now, with this removal of the supplemental liquidity ratio, if they have, let's say, $2.6 trillion more in capacity, they might not actually use much of that if business conditions are bad, because there has to be a demand for the loan before a bank will make a loan. And the banks have to have good prospects. They have to have somebody that's, they think they're going to get paid back, that's got good collateral and all the rest of it. Mm-hmm. They have to have, in short, what Matt Sakursky and I call bankable projects.
Yes.
And if they do, by the way, they'll use that and expand the rate of growth and credit, and that will expand the money supply. Right now, by the way, just to give you an idea, the commercial bank credit is growing at 5.1% year over year. The growth in the overall money supply is 4.5%. The Fed is actually not contributing. It's basically flatlined. It's not contributing to the overall growth. The commercial banks are the engine that's driving things, but that's not unexpected, because the banks, as I say, are the elephant in the room anyway.
Mm-hmm. Hey there, I just want to take a quick moment to thank you for watching this video, and I would really love for you to subscribe to this channel if you like this content. Over 70% of our viewers are not yet subscribed, and we are on a mission to hit 100,000 subscribers. So if you could, just take a quick moment, hit subscribe. Thank you so much for your support. We appreciate you, and back to the video. Before I let you go, Professor Hankey, a couple of other things. Our last conversation, which was 5 months ago, you said at the end that we should watch the price of gold, which is, I think, is up about $700, $800 since our last conversation. It's looking today. It is, where are we today? Just north of 4,100 today. It's been kind of consolidating around the 4,000 range, but it's up today. Curious, maybe your thoughts on gold, just watching it. What has it been signaling to you? And just more curious, what is gold kind of sniffing out?
It is consolidating around 4,000. It seems to be stuck in like flies on fly paper around 4,000 and consolidating pretty well. But if you look at the expectations, the call contracts, the options for calls are greater than the puts by a considerable amount, and that signals that it's going up. People in the market think it's going to go up in the options market, so that would be one point. Fundamentally, I think we are in a secular bull market, and I've indicated I think the top is probably around $6,000 an ounce. So it's got a ways to go.
Yeah, certainly. You also said to pay attention to the 10-year yield and the US dollar versus euro. I think that was the other thing. Those were the things you told us to pay attention to. Any thoughts there?
They've been very, very steady. The dollar euro rate's been very, very stable and not moving very much. And the 10-year is just a tad over 4% now. It's been pretty steady too for not all the time since we talked, not for 5 months, but certainly for the last month or two. It's been hanging in there just around 4, a little over 4. So the markets have those markets. If we look at gold, since it pulled back from its high, it's been steady at around 4,000 and consolidating. This is for, let's say, the last month, and the 10-year has been around 4%. That's pretty steady, just a little over 4.1, and the dollar euros, it's around 115, 116. Pretty steady.
Pretty steady, yeah. What's the probability of a recession for you today? What is that probability? Maybe the next 12 months? Has that shifted or changed?
Well, out of all the things that Greenwood and I predicted, we got the boom and after COVID. And as you said, we also got inflation after COVID. So those two we got right. We said the economy would boom, asset prices would boom, and we'd have inflation. We got them. And then the money supply started contracting, and we said, well, the inflation is going to come down, and which it did, and we got right on that. But we thought that we'd end up with a slowdown in the real economy, and it just never panned out. We didn't get that. And now my thinking is I'm thinking we might make it through without much of a slowdown if this acceleration in the money supply that we talked about earlier, if that actually occurs.
Mm-hmm.
So
yeah.
I'm kind of in terms of the real economy, I'm kind of on the fence right now, because number one, I've missed the slowdown part of the thing, but there's still some things in there that make me watch, and that's what's going on in the labor market. The labor market is getting weaker, and that's what's concerning some of the people at the Fed too. The Fed's reading, by the way, the labor market is more or less consistent with my own. But if so that's the kind of, yeah, maybe we'll slow down, and we have all the uncertainty associated with the Trump tariffs and so forth, and just the general uncertainty, the regime uncertainty, with everything from a policy point of view in Washington changing all the time, and Trump changes his mind, every 24 hours. So all of that is kind of on the slow down side. But on the acceleration side, I've got this thing I'm concerned about, and that's a significant increase in the rate of growth in the money supply. So that's why I'm kind of on the fence.
Interesting. So
I think we're for me, it's a difficult call.
Yeah, certainly. So on the labor side, though, then that would justify the 25 basis point rate cut then.
Yes. And I think that's why these probabilities for the rate cut have swung around tremendously in the last week. Because in fact, just yesterday, the president of the San Francisco Fed indicated that she thought that the labor market was looking weak, and that meant a 25 basis point rate cut would be justified on the December 10th meeting, at the December 10th meeting. So they're more or less reading the labor market the same way I am. It's not bad, but it's getting weaker.
Well, Professor Hankey, I have to say, I always enjoy having you on the show. This audience absolutely loves you too. I want to encourage everyone to go pick up a copy of your book with Matt Zerkirke, Making Money Work. Send it to your friends. Get those folks at the Fed to read it. But Professor Hankey, really appreciate you. So grateful for all of your knowledge, your wisdom, helping us all learn, get better. Thank you so much for being a friend of this show. And I wish you and your family a happy Thanksgiving. And I look forward to our next conversation. Thanks again, Professor Hankey.
Well, thank you, Julia. We certainly wish you a happy Thanksgiving too.
Thank you so much. Really appreciate it.